Welcome back to Finance with Focus, ER, where we make global money topics simple, educational, and eye-opening. If you enjoy international wealth comparisons, hit like, subscribe, and comment where you would invest $100K. Now, let's compare two of the world's most powerful economies, the United States and Germany. On the surface, they're both titans of industry and innovation. But when you look at how their citizens build wealth, you uncover two profoundly different investing cultures. It's a fascinating story of history, psychology, and financial behavior. Before we dive into specific investment products or dollar amounts, we have to start with the foundation, the mindset. This isn't just about personal preference. It's a collective financial psychology shaped by decades of unique national experiences. Of course, these are broad cultural trends, and individual approaches will always vary. First, the American mindset. The unofficial motto could be summarized as, grow wealth and grow it fast. This culture is generally more comfortable with risk. The stock market isn't seen as a casino, but as the primary engine for wealth creation. This is reflected in the data. Over 60% of Americans own stocks, one of the highest rates in the world. There's a deep-seated trust in entrepreneurship. The American dream is intrinsically linked to the idea of starting a business or a side hustle, viewing it as a direct path to financial independence. From an early age, Americans are encouraged to invest, often through workplace retirement plans like 401ks and individual accounts like IRAs. The system is designed to funnel money into the market. Even with the memory of major crashes like the dot-com bubble and 2008, the prevailing narrative is one of resilience and long-term recovery. The lesson learned wasn't to flee the market, but to buy the dip. Consequently, wealth is often seen as an achievable goal for anyone willing to take calculated risks. Now, let's cross the Atlantic to the German mindset. Here, the philosophy is almost the inverse. Protect your money first, and only then grow it slowly. This mindset demonstrates a strong preference for safety, predictability, and stability. The fear of losing money often outweighs the desire for high returns. This caution is evident in stock ownership, which hovers around just 17% of the population, a stark contrast to the US. There's a deep cultural trust in tangible assets. Cash savings held in low-yield bank accounts and physical real estate are the cornerstones of wealth preservation for many German households. The idea is to build a fortress around what you have. This perspective is heavily influenced by history. The collective memory of hyperinflation in the 1920s and the complete economic reset after World War II created a deep-seated aversion to risk. The lesson passed down through generations was that financial security is fragile and must be guarded vigilantly. As a result, wealth is approached with immense caution and conservatism. Financial planning is less about speculative growth and more about meticulous saving and debt avoidance. Right away, you can see how these two fundamentally different mindsets, one prioritizing growth, the other prioritizing security, will lead to two completely different strategies for investing the exact same $100,000. Chapter 2. How they'd split the $100K. You have $100,000, a life-changing sum. But how you invest it depends heavily on where you live. Let's break down how a typical American and German might approach it, starting with the American model. Of course, these are generalized models, not financial advice. Here's a look at a typical American allocation. It's a portfolio built on a foundation of optimism and a belief in market growth. The largest slice, 40 to 50%, goes into the US stock market. Americans lean into growth assets because, historically, the US market has shown remarkable long-term resilience. Much of this tracks the S&P 500, the 500 largest US companies, which serves as a benchmark for the market's health. Within this, there's often a significant allocation to tech stocks, the engine of modern market growth. And increasingly, investors use growth ETFs, or exchange-traded funds. An ETF is like a basket containing hundreds of different stocks, offering instant diversification. This strategy allows Americans to bet on the market's overall progress. Next up, retirement accounts claim about 20 to 25%. This is where long-term tax-advantaged growth happens. We're talking about the 401k, an employer-sponsored plan where your company might even match your contributions. That's free money. Then there are IRAs, or individual retirement arrangements. A Roth IRA is funded with post-tax dollars for tax-free withdrawals in retirement, while a traditional IRA uses pre-tax dollars for a tax break today. The tax benefits and compounding make these vehicles incredibly attractive. Real estate typically makes up 10 to 20%. With $100,000, you're likely not buying a property outright. Instead, this money is used strategically, perhaps as a powerful down payment on a home to start building equity. Alternatively, for property exposure without being a landlord, this money could go into REITs, real estate investment trusts. These are companies on the stock market that own and manage portfolios of properties. Then comes the high-risk bucket at 5 to 10%. This is the speculative, moonshot money. Americans are often more comfortable taking a calculated gamble on high-risk assets. This is where you'll find crypto like Bitcoin, angel investing in startups, or alternative assets like fine art and collectibles. It's a small slice that offers potential for outsized returns, embodying the American appetite for risk. Finally, cash and the emergency fund make up the last 5 to 10%. This isn't idle money, it's a strategic reserve. Standard advice is to keep enough liquid cash to cover 3 to 6 months of essential living expenses. This provides a safety net for emergencies without having to sell long-term investments at the wrong time. Now, let's cross the Atlantic to the typical German allocation. The difference is immediately striking. The German approach is defined by one word: Sicherheit, or security. It's a portfolio built to withstand storms, not just chase sunshine. The largest allocation, a massive 30 to 40%, is held in cash savings, a stark contrast to the American model. Germans prioritize liquidity and capital preservation. This money is often in high-yield savings accounts, or a popular product called a Tagesgeld account, a daily access savings account with a modest interest rate but complete flexibility. For the German investor, knowing the money is safe and accessible is the top priority. Real estate is the second pillar, also accounting for a huge 30 to 40%. Germany loves property, viewing it as a tangible, stable, long-term anchor for wealth. While Germany has a lower home ownership rate than the US, those who invest in property see it as the ultimate security asset. With $100,000, this could be a significant down payment on an apartment to live in, or, very commonly, to rent out for stable, long-term income. Next, about 10 to 15% is allocated to bonds and other safe investments. This is the core of the German safety-first philosophy. We're talking about German government bonds, or Bunds, considered among the safest financial instruments in the world. Essentially, you are lending money to a stable government for regular, predictable interest payments. The goal isn't high growth, it's unwavering stability. Stocks, or Aktien, make up a surprisingly small portion, only 10 to 15%. This is the most dramatic difference from the American portfolio. Fueled by historical events like hyperinflation, there's a deep-seated cultural skepticism towards the stock market. As a result, Germany has historically had one of the lowest stock market participation rates in the developed world. Finally, private pension plans take up the last 5 to 10%. To supplement the state pension, Germans use government-subsidized private plans. The Riester-Rente is for employees, offering bonuses and tax breaks. The Rurup-Rente is for the self-employed, providing significant tax deductions. These are not high-growth vehicles. They are slow and steady instruments for a secure income in old age, aligning with the national focus on security. So already, we see a massive difference. One country builds wealth through growth, the other through security. But which strategy actually wins over time? Let's break it down. Historically, an American-style portfolio with heavy stocks could grow 6 to 10% per year on average. Over 20 years, $100,000, $320,000 to $650,000. German portfolios grow slower due to lower stock exposure, higher cash reserves, which don't grow, safer assets over 20 years, $100,000, $180,000 to $260,000. The big takeaway: Americans typically end up richer due to more compounding, higher exposure to growth, and less fear of investing. But Germans experience less volatility and less stress, which many consider a win. Why the strategies are so different? To understand the gap, we have to look at the systems themselves. The U.S. ecosystem is fundamentally designed to encourage private investing. It starts with accessibility. Opening a brokerage account is often a matter of minutes. Then there are powerful structural incentives. Flexible retirement systems like the 401k and IRA are widespread, with many employers offering contribution matching, essentially free money for investing. Tax policy also plays a huge role, with lower capital gains tax rates rewarding long-term investment over short-term speculation. This is all layered on top of a culture that celebrates business, growth, and homeownership as a primary vehicle for wealth. For many Americans, the stock market isn't just an option. It's deeply tied to their personal financial identity and the nation's economic pulse. In contrast, the German system is built to encourage stability. The foundation of retirement is the robust state pension system, which provides a reliable, albeit modest, income floor for most citizens. This significantly reduces the perceived urgency for individuals to take on market risk. Culturally, there's a deep-seated caution, a legacy of 20th century economic traumas like hyperinflation, which fostered a profound trust in tangible savings and a wariness of stock market volatility. This safety-first mindset is reflected in consumer behavior. Germany has one of the highest renter rates in the developed world, meaning less capital is tied up in home equity. The financial landscape prioritizes secure, low-yield savings products over equity investments. So it's not that one population is inherently more risk-averse than the other. It's that each is responding rationally to the distinct set of rules, incentives, and cultural norms they operate within. The American system rewards risk-taking to achieve growth, while the German system rewards prudence to preserve stability. So, which strategy should you follow? Americans grow faster, Germans play safer, but the best approach might be a blend of both worlds. A powerful wealth strategy would combine American growth, higher stock exposure, maxing tax-advantaged accounts, and long-term compounding. German stability, strong cash reserves, a real estate foundation, and avoiding excessive risk. Balanced investing equals lower stress and higher returns. This hybrid approach is what many global investors are now adopting. If you had $100,000 today, which strategy would you choose, American or German? Drop your answer in the comments. If you enjoyed this global money breakdown, hit like, subscribe, and share this with someone who wants to build smarter wealth in 2025 and beyond.